Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. We're shifting our focus to fixed income this week, with markets constantly shifting and interest rate cuts in the spotlight. Our guest shares valuable insights on navigating volatility, finding opportunities, and managing risk.
I'm Chris Sarley, and today we're joined by Stuart Edwards, manager of the elite rated Invesco Tactical Bond Fund. Stuart, once again, thank you very much for joining us today.
Hi, Chris. It's a pleasure.
Let's start with sort of a broad base of explaining the fund to the listener. So obviously this is a sort of a go anywhere, do anything type of fund in the fixed income sphere, has lots of strings to its bow. I think we've talked in the past about the sort of three components that make up the fund and sort of a bit more on the top down, bottom up. Maybe just give us spend a couple of minutes giving us an overall view on how the fund actually works and what you've been doing in the sort of past 12 to 18 months on it.
Yeah, sure. Fixed income or bond markets, it's a very broad church. It means lots of different things to different people. Some people use fixed income as a sort of safe haven part of their portfolio. Other people use it to tap into more risky parts of the market. So corporate bonds, for example, which can include high yield bond markets, which is low, higher risk corporate bonds. This fund is designed to tap into all of the different elements and the areas of the bond markets. It's, as you said, it's extremely flexible, and it's designed to take advantage, I guess, from what is effectively a very volatile macroeconomic environment, as I'm sure all your listeners are very aware. So, what does it look like in practice? Well, I think there are three components, essentially. As I said, it can tap into a broad universe. So it can adopt different interest rate strategies. We can manage the duration of the fund. It can take advantage of opportunities in corporate bond markets. So that's investment grade, which tends to be higher quality and high yield. But also emerging markets as well, if we feel that we're getting rewarded for taking the risk. So, the starting point, it depends on our fundamental view of the world, how much risk we want to take and where we see attractive valuations. And then the second component, I'd say, is flexibility. This is called the Tactical Bond Funds, and in that sense, it does what it says on the tin. It can at times be very tactical. We can be flexible with our allocation, but also our duration or interest rate exposure. And we can sort of take advantage when we think that yields have gone too high. We can add duration, and similarly, if we feel that the bond market has rallied too much and yields have fallen too much, then we can take some of that risk off. So flexibility, absolutely key. And then the third component, I would say, the fund is downside aware. So, what does that mean? If this was a more sort of generic corporate bond fund, then you are paid or expected to be invested at all times in corporate bond markets. With this fund, we will invest in certain areas. As I said, it could be investment grade or high yield corporates or emerging markets if we see value. And in practice, that means that perhaps the hurdle for taking risk is a little bit higher than it might be for a more generic corporate bond fund. And equally, the hurdle for reducing risk might be a little bit lower. So that's our approach. We can't obviously promise that we won't lose clients' money, because we can't do that. But we are downside aware. It means that there has to be compelling valuations really for us to be involved.
And we're sort of going to just weave a couple of questions on the back of that. So top down with the macro awareness coupled with the sort of bottom up of stock selection, and then also how that downside aware feeds into the past 12 to 18 months, which have been a very interesting time for markets. Maybe just talk about how that top down bottom up sort of works, and then in tandem with what the last 18 months has looked like as in the economy.
Yeah, sure. And both the top down and the bottom up are important. But we always start with the top down because it helps inform us what type of interest rate exposure we want in the fund. So that's our known as the duration exposure of the fund. where we want that interest rate exposure to be, whether it's in the UK, whether it's in the US, whether it's in the Eurozone, for example, and how much risk we want to take outside of interest rate exposure. So that's typically credit exposure. What are valuations looking like in corporate bond markets? What is our macro view of the world? Is it an environment where we should be taking more credit risk? And that might depend, or it will depend on the economic data. It will also depend on our view on what we think central banks are going to do. So, that's always the starting point, is the big sort of macro picture, and it's always evolving. Right? It never stands still, as we know over the last couple of years. At times, the focus has been very much on inflation. Other times, the focus has been on growth. And this is a constantly sort of moving environment. So that's the starting point, trying to get a handle on this big picture view of the world. But equally, the bottom-up approach is very important. We have a team of highly qualified corporate bond credit analysts that cover different sectors. So they'll give their views on where they're seeing value and where they're seeing risks. And they themselves will drill down to individual opportunities as well. So they'll look at when company results come out, they'll look at the company results and opine on whether there's value, and if we hold the bonds, whether there's a risk to in continuing to do so. So the bottom-up analysis is extremely important as well, and I'd say that extends to emerging markets because emerging markets is often sort of people sort of consider it one big sort of opportunity set, but in reality there's a lot going on underneath the surface as well, if you can imagine, with all the different monetary policy cycles in emerging markets, etc. So we have extensive resources throughout Invesco, and we have an excellent strategist who sits within our team, where we're based in Henley, who looks at these opportunities in the emerging market space. So the bottom up is very important there as well.
Okay. I wanted to talk a little bit about the UK, and maybe we can broaden it out beyond that. But obviously, we've had a couple of rate cuts last year. We've seen one already this year. What sort of impact are you expecting this to have, on the portfolio in terms of your outlook, and what are you expecting going into 2025? I mean, spreads are tight. Do you expect there to be significant changes, or are you sort of very much in the risk-averse camp at the moment?
Oh, look, the UK is a fascinating space from a macroeconomic perspective. I'm sure all your clients are following it closely, and particularly the interaction between monetary policy and fiscal policy and inflation and growth risks. So, it's quite a complex picture, but it's one that has given us a lot of opportunities over the last couple of years, because it's been very volatile, where at times the markets have not priced much in the way of interest rate cuts in. And, we've taken issue with that. We've thought that there should be more. And equally, the pendulum can swing the other way as well, where, there are too many cuts priced in. So, it's quite a volatile space, and we try to be quite active when it comes to our UK interest rate exposure for that very reason. Coming back to your question, I always get asked what I think. I'm always a bit reluctant to make predictions, but, for us, it's all about where the risks lie relative to what is priced in. So we came into the start of this year believing that with only two further interest rate cuts priced for 2025, that wasn't enough, given the potential downside growth risks, particularly in the labour market, which, we are seeing signs of some weakening there. So, it was quite an easy decision to take our UK interest rate exposure up a bit, for that reason. And since then, as you said, we've had another rate cut. And now we're in a position where I think there's somewhere between 2 and 3 further cuts priced for this year, which I think is reasonable. If you were to hold me to a central view, I'd say that that's about right. But I would probably still say that the risks around that are asymmetric. and that if these downside growth risks do continue to materialise, then ultimately the Bank of England will have to cut more aggressively at some point, particularly towards the back end of this year and into next year.
And just quickly, you mentioned the opportunities. Where are you seeing the opportunities in the UK? Are they across the market? Are they in certain sectors?
We've seen some good opportunities in some of the better quality corporate bonds at the short end in particular. So at times when the market has moved to price in not many rate cuts in the UK. So in other words, and at times actually over the last 2 years, have priced in more rate hikes. I mean, obviously, the Bank of England's been cutting rates over the last sort of 6 months or so. But prior to that, there were times when there were just too many rate hikes priced into the UK, and that allowed us to take advantage by looking for some decent issuers who issuing in sterling and picking up some decent yields in the front end. We do still like the banks for the most part. We think financials are still in a good place. Balance sheets are pretty strong. Banks are well capitalized. Although one could argue there are downside economic growth risks, the banks are more than equipped to, deal with that. It's not, I wouldn't say it's those downside risks are material enough to, at least for now, impact valuations there. So we still like the banks. We still hold bank capital, particularly in shorter dated maturities, because you get some nice attractive yields, the likes of Barclays, for example, where we expect Barclays to what's called, just a bit of a technical term, but call those bonds and effectively redeem them, so you can get a nice short-term yield in some of those issues.
I didn't want to spend too long on inflation. It's been a bit sticky in the UK, and there's talk of it going up again. Maybe just do you make any preemptive calls on inflation as well, and does that impact the portfolio? With that risk-averse hat on, just give us a bit of a line on that, so we can see where you stand on that, please.
Yeah, we're not really in the business of forecasting inflation. We'll let others make those mistakes, but we are in the business of making an assessment and a judgment on where the risks lie, and looking at the underlying trends in inflation, and that's not just at the headline or a core level, but also the key components as well. So inflation is expected to pick up once again in the UK. Clearly nowhere near the levels that it did. I think it was back in October 2022 when it peaked at around 11%. I think I have that year right. It's some significantly way below there now. But there are certain factors that are causing it to increase once again. Energy prices, food prices, I think utility prices, VAT on school fees, for example. We've got the policy measures from the recent budget, the increase in employers' national insurance contributions. There's some uncertainty about how and whether businesses can pass that on. And also the increase in the national minimum wage as well. So, there's various factors that are causing this likely bump in inflation into the spring and beyond. But the key point I would make is the Bank of England know this. It's in their forecasts, it's in their projections. So, and actually, one of the interesting outcomes from the most recent Bank of England meeting is that they made a judgment on the supply side of the economy, which, in their opinion, means that inflation could sort of stay a little bit stickier for a bit longer. So it's in their forecasts. So we have to make a judgment of where the risks around those forecasts lie. And I think we take the view that once these downside growth risks that I alluded to materialise as we sort of progress through this year, and particularly if the labour market unfortunately weakens, then ultimately that will keep a lid, or should keep a lid on inflation in the medium to longer term.
I wanted to sort of cast, you talked about inflation, I just want to sort of focus on the other side of the pond. We've got a new Trump 2.0 is kicking into full gear. Obviously the US has been very resilient, recession resilient, or as may be. Obviously a lot of his policies are very inflationary. Do you see that strength continuing? Does that come into your macro forecast? Maybe just cast an eye on the US for us and how you play that at the moment in the portfolio.
Yeah, sure. I mean, look, as I'm sure most of your clients would know, the US is all important when it comes to the direction of global fixed income markets. So we spend a lot of time, really digging into the weeds when it comes to the US economy. And look, it's true. I mean, if you go back to 2022, 2023, there was a very, very strong consensus that the US would go into recession because of the aggressive rate hikes that we had over that period. And it just didn't materialize. And, I think there are several reasons for that. I'm not going to go into extensive detail, but there was strong fiscal support and stimulus in the sort of COVID and the post-COVID world that partly bolstered consumer savings, right? So that helped the consumer. Services demand remained very strong post-COVID. Everyone wanted to travel. I think more recently, the fall in inflation has boosted real incomes as well. And of course, we've had the Trump election, as you've mentioned, and half the country is very happy, you think, and perhaps half the country a little bit less so. But as is often the case after US presidential elections, you often do get a bit of a bump in the growth data. And I think in some of the sentiment indicators that we look at, that is certainly true. As for what happens through this year, look, I mean, there are some factors that I think quite obviously or should support US growth, deregulation being one of them. Also, Trump has stated that he wants to extend the tax cuts from 2017. That should be supported. But there are other things that work in the opposite direction as well. Everybody's, I guess, following the this Dodge or Doji department that's cutting government expenditure. I mean, if that proves to be comprehensive and extensive, then you'd think that would have an impact. The curbs on immigration. I mean, I think there's been something like 7 to 10 million immigrants over recent years. I don't know the exact numbers, but that's boosted the US economy, particularly household consumption. You'd think that if that at least stabilized, if not went into reverse, then that could be a negative. And also tariffs. Ultimately, that's a tax on consumers. So if the full sort of threat or promises on tariffs are implemented, then that could ultimately be quite punitive as well. So we'll just have to see. I think we're getting a bit of what I term as a Trump bump at the moment. But I think over coming months, things should become a bit clearer. The only other thing I would say is that the US labour market, I mean, it has improved a bit over recent months, but it has been on a moderating trend over the past sort of 12 to 18 months, which is something that we're monitoring very closely. What we haven't yet got is active layoffs, but the hiring rate in the US is moderating for sure. So that is definitely something to watch, and that we're certainly keeping an eye on.
Just quickly, because we've been sort of dancing around geographies, you also have a small allocation to emerging markets. Could you just talk me through that? And are there any fundamental differences in what you look for in an emerging market bond versus the developed market?
Yeah, I mean, as I said earlier, the emerging markets, that's a broad church. There's a lot going on there. There's certain central banks that are far more conservative and prone to hiking interest rates more aggressively in order to fend off inflation pressures and ultimately protect their currencies. Others less so. So, for example, Mexico has been quite aggressive at hiking rates in recent years, as has Brazil. On the other hand, Turkey hasn't. So there's quite some contrasts there. So we're looking for I guess in terms of local bonds, we're looking for central banks that have a hawkish lean in. Now, ordinarily, your clients might think, well, surely that weighs against fixed income, but it's about getting, what it amounts to is, if these central banks are hawkish, then ultimately that's going to crimp down on inflation and economic growth, and then that means that at some point you can see good value in some of these local bond markets. So we're seeing some very attractive yields, for example, in local Mexican and local Brazilian debts at the moment, because these central banks have been quite aggressive at hiking interest rates. There's other things that are going on as well. You have to watch the fiscal side of things as well. I think in emerging markets versus developed markets, though perhaps we could say the UK was a good example where this is not true, but certainly in emerging markets, if the authorities have not got control over the public finances, then investors it's a higher hurdle for investors to have confidence, in these markets. But as I said, the same is true for developed markets as well. We've seen recently how there was a bit of a wobble in the UK gilt market because of concerns about public finances. So I don't think it's just confined to emerging markets anymore, but certainly we look at the public finances in great detail as well.
I wanted to touch quickly on duration. In your case, the duration of the fund is a lot higher than it was a couple of years ago. Maybe just start by explaining to the listener what duration is, and then just talk to me through, is your duration higher from a very low level? Maybe just give us an idea of where it is in the grand scheme of things at the moment.
Yeah, sure. So duration is a measure of the interest rate sensitivity or the price funds sensitivity to changes in interest rates at the fund level, and then obviously when it comes to individual bonds, the same theory applies. So we can adjust the interest rate sensitivity of the funds. We can adjust the duration of the funds, and that what I would say about that is structurally the duration of our funds is significantly higher than it was 2 to 3 years ago. But 2 to 3 years ago, bond yields were not much above zero. In that sort of zero, low interest rate world, there was just no valuation in bond markets. So for us, it made it quite difficult to take duration up. The risk seemed very, very asymmetric, as you can imagine. So if you go back to late 2022, we had the duration in the funds very close to zero. Now it's significantly higher than that because bond yields, government bond yields at least, are looking a lot more, compelling in our view. Now that said, and as I sort of made the point earlier, the macro environment is very, very, very volatile when you've got this tug of war going on between inflation and growth. So we still think it's an environment where you should be very flexible and nimble with your duration, with your interest rate allocation, because these bond markets are still very, very volatile. We've seen some quite big yield swings over recent years, and I think that will probably continue. So I think it's prudent for us to not get wedded to a really high duration view. I think it's important that we're pragmatic and we're constantly looking at the fundamentals, but more importantly in the context of the valuations on offer as well. So yeah, we make no apologies. We are very flexible with our duration allocation. It's never perfect, but I think we've done a reasonable job over the past couple of years at managing.
And just lastly, maybe to sort of knit it all together, we've talked a lot about the macro, and you've mentioned that things are volatile to say the least. We've got government bonds over here that are sort of offering a fair return, and the spreads are perhaps not as attractive as they have been, but that doesn't mean they're totally unattractive. Maybe just talk to me. I mean, in terms of the position in the portfolio, do you feel that there's a lot of opportunity out there? There's a lot of dispersion to find, good attractive opportunities for the portfolio, and how helpful is that flexibility in sort of bringing that out?
So it's a great question. There's always opportunities in these bond markets. There really is.
Dispersion must be rife across every sector in the market.
So we're seeing in this higher yield environment, we're seeing a little bit more differentiation between the central bank cycles and the macro fundamentals in different countries and regions. So that's given us an opportunity. We're quite flexible, not just in terms of our overall duration allocation, but also, as I think I mentioned, between different countries and regions as well, right? So we look at country spreads, for example. So that gives us some opportunities. And emerging markets, we've obviously touched on. There's some good diversification opportunities, really good yielding opportunities there also. In terms of our allocation between government bonds and corporate bonds, what I would say is that we still have a decent allocation to corporate credit. It's just significantly lower than where it was several years ago. And there's good reason for that. Credit spreads, difference between corporate bond yields and government bond yields, in our opinion, are quite narrow. So we're not getting that sort of relative valuation advantage. We don't see a compelling reason to take more risk and invest in the corporate bond space when you're getting perfectly attractive yields in government bonds. And there are, potentially downside growth risks as well that could emerge over the next sort of 12 to 18 months. We've touched on the new US administration. We've touched on what's going on in the UK. We haven't really spoken about Europe, but Europe really is at the epicenter of Trump trade wars, potentially, particularly if he goes after the auto sector, which is important to Germany. So, there's lots of reasons to think that, growth risks are over the foreseeable future, perhaps skewed a little bit towards the downside, which would, for us tend to favor government bond exposures over corporate bond exposures, particularly when the valuations in corporate bond markets are not that compelling. So that's where we sit at the moment. We're a little bit more defensive on the credit side than we were a couple of years ago, but we've got a little bit more duration, or quite a bit more duration actually, than we did have 2 years ago. But we are being very flexible and very nimble with that.
Stuart, on that note, thank you very much for joining us today on the podcast.
Absolute pleasure.
As we've heard today, the Invesco Tactical Bond Fund is the most flexible fund in Invesco's fixed income range. This means the team can make the most of all the opportunities presented across the market. To learn more about the Invesco Tactical Bond Fund, please visit FundCalibre.com. And whilst you're there, don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.